And we're live for another of the unmissable Sunday shows. Hey, Benny, how are you?
Unmissable Sunday show. That should be our new tagline. I'm good. I'm good. I was a crazy guy who left South Florida to come back to Wisconsin for my father's 71st, right in time for 15 inches of snow. I don't know what I was thinking.
Well, at least you're not in a war zone. So, line up for today. This week is Ags week. We'll get to that in a minute, and I'll explain why. And we've got a great guest coming up on Thursday to wrap it up. But we're going to run quickly through the state of cross-asset markets first, and we're going to kick off with. You came up with a great chart that we didn't have time to stick into the show with Danielle last Thursday, but this analogy around the dollar and policy, around oil and policy rates, I think is a really interesting place to start.
Well, I think you can also think of SOFRs, or back then Eurodollars, as discounted future dollars, right? Like that's ultimately what you're getting. So it's the most, liquid market in the world, probably most efficient, but sometimes not, because there's a positioning. So, there's a Fed paper that came out that showed that the poly market, or the Calci, I don't remember which one of them, was actually been more accurate in policy rates than Fed funds futures or SOFRs. And that's partially because, remember, there's huge money in this market. So sometimes you'll get these gap ups and gap downs, and it's just positioning, right? And the market has to absorb it. And a lot of people are positioned, so the incremental positioning might get overwhelmed. So let's go back to 08. And, we see in the red line, which is the generic, CL1, which is the front month WTI, we have this monster run from 60 to 147, July of 2008, which, by the way, just so everyone knows, I shorted that at 146, but I got out of it at 121. So I missed a lot of it, but I could top tick that one too. The top ticker hit then. But look, let's talk about SOFRs, because I think everybody listens here knows that I've been bullish SOFRs. Rupert owns SOFR calls. But what we see here is that you did get a counter trend rally, right? So on the show on Thursday with Danielle, there was a consensus amongst the three of us that that black line will play out similarly to what it did back then. But remember, SOFRs are a leverage product. That was a big move. We went from 97.45 or so, and I think it touched 95.50 very briefly before rebounding. Now, here's the thing. You got to remember that these things can be very dangerous if you're too levered. So you have to be aware of this. One thing I would put as a caveat is, remember, there's a difference between Eurodollar futures and SOFR futures. SOFR are secured, Eurodollars are unsecured. And so there was a credit spread embedded in Eurodollars that you have to be aware of when you compare historical moves. So think that credit spread definitely blew out in that. So I wouldn't say, the magnitude should be apples to apples or anything, but I'm just giving you an example that I can be right about where we're going and be wrong in the short term, which I have for the last week, right? I've had people come to me and ask me, do you still like them? And yeah, I do, but that doesn't mean that we might not lose another 30 basis points or something, which when you have as many as I do is very painful.
Yeah, I know we got run over last week, but I bought the dip on Friday. But I'm in the position mainly with calls, right? So it's and actually vol went up. So my first tranche actually didn't get impaired that badly because and we'll talk about Treasury vol in a second, because the vol surface moved up. That gave me a bit of protection, but I think it's instructive that that analog chart is interesting. I mean, ultimately, I haven't seen where crude's opening tonight. I imagine higher, right? At some point we will get to that 120, 130, 150. God help us, possibly even 200, and that's what breaks things.
Yeah, I think inflation adjusted, it's like 215 or something. I'd have to double check, but I think if you were to replay the 147 in 2008 dollars, it's around 215, 220, somewhere in there. Not that that's where we're going. Let's be fair. that was a different oil market. That was a pre-shale market. You know, in Q3 of 2008, the U.S. did less than 6 million barrels a day of production. We're now the number one producer in the world, about 14 million. So let's just be clear that was a different time, different kind of supply, issue, basically.
We just weren't at war. Anyway,
we were at war. We were at war. To be fair, Iraq was going on then. To be fair.
Yeah, fair. Okay, let's move on. You wanted to talk about the swap spreads.
Yeah, I think people got to remember. Swap spreads going negative. Swap spreads are kind of the cost of leverage. That'll be the way I think about them. And pre 2008, so go back to the 2008 analog. They always traded at a premium to treasuries because banks are naturally riskier. I mean, we go back in history and how many damn banks have gone out of business. I mean, Rupert's worked at one of them, to be fair. But anyway, my point about this is that once the Volcker rules came into place and balance sheet capacity became a huge thing, I've always kind of thought of swap spreads as a balance sheet capacity proxy. Now, it's not perfect, and you're never going to get it exact, but you see, like, let's go back to the liberation bonanza of last year. You see how they spiked down, and that means tightened, right? So tightened, it's getting more negative, meaning it's more expensive, right? So just remember that's what it means. It means negative versus treasuries. So if you want to go and get fixed at a bank via a swap, you're paying a huge premium. And so we're seeing this down. And to go to the next slide, I'll switch it. This is how it looks in the curve. So as you would naturally expand out term, the spreads get more expensive. So I like to look at the longer end as like the more pure, because to go back again, you see how the green line is a 30-year. You see how sharp that is. The 2-year, yeah, it's moved down. If I just isolated it, it would look more dramatic. But compared to the term side, the 10-year and the 30-year, which goes, I don't know what that was, 35 to 48, that's 13 bips. And this was, let's call it 20 bips on the long end. It's more dramatic. And so there's some people who say it's a fear of all the duration extension that could happen. Some people just say there's a lack of collateral. That argument can be had at a different time. But regardless, it just means cost of leverage is going up, basically. And you got to be cognizant of that now.
That's the punchline. That's the punchline. And that makes perfect sense. It feeds into the whole Hunger Games mental model. We're in a deleveraging at the moment, and capital is in short supply.
Yep.
Okay. So,
and just on that, go to the next one.
Yeah.
You've seen. Okay, so we'll do a little bit of a quick review of rates volatility, equity volatility, and a little FX volatility quick, and then we'll move to the Ags. You've seen a decent bump in, implied volatility on the 10-year. And that's the blue line is the delta calls, the red line is the puts, 25 delta, and the black line's at the money. And then the skew, which is 25 delta skew, is on the bottom. So, skew has not gone up as much as it, did if you go back to the craziness of 2020, but it has spiked off the low. This is the 5-year. It's a little more dramatic. You can see the skew there has really popped up. Same kind of thing, and you could look at the move index, same thing. I'm just trying to give you a different look than you would just by the generic move index, which most people look at. And, basically now we're going to look at this SPX. This is one thing that has been talked about a lot. If you guys are Twitter people or, there's been this premium of implied vol versus realized vol, and that's what you'll see at the bottom. And so we're above this kind of red line over the last 15, 16 years. We're not at the highs, but we are at elevated points. So the market is definitely well hedged, but we have opex on Friday. So be aware of that. Like, remember, Wednesday, Thursday is when that will start to decay for dealers. And so there's the risk that this keeps going, and then eventually the dealers will have to get there. But right now, that's more in the price of vol versus vol than it is, just at the money, I guess, was the way to think about that.
So how are you thinking
And
about your how are you thinking about your playbook into opex right now? What are you seeing as a path for this week?
I mean, what is your view on what happened this weekend? Do you think escalation, de-escalation?
It feels like escalation to me. It feels risk negative. I haven't got my screen open. I'm still
Would that be because the Carg Island?
Yeah, I mean, I think that there are people that are saying that Carg Island is, it was just military targets on Carg Island. It wasn't the, it wasn't the export terminals, etc. But it feels I mean, however you want to play that down, it feels like an escalation to me.
So I hear you, but I'm looking like right now, Bitcoin's up about 80 bips, Ethereum's up 120 bips. Dollar, euro, or Eurodollar, euro in dollars, 10 bips. Sterling's up 13 bips. So these don't indicate that we're going to have some massive, ugly Sunday right now, as of now. I hear what you're saying. I'm not very confident in where we're at right now on that. I think that there was a decent catch up, which I think, I posted out and we talked about. We got that Monday dump in oil, and I decided, like, you know what, we're gonna take another shot at this at like 84.50 front month oil, and I faded the SPOOs at 68.15. That worked throughout the week, but again, now we're back in the high 90s, and SPOOs are near the low, or they close near the lows. We'll see where we open. I don't know. I tend to be a little bit apprehensive because. Go ahead. Sorry.
I really hope we get a quiet Monday because I've got some more stuff to sell, right? I mean, I think that if we do get a quiet Monday, Tuesday, I think it's another great opportunity to lighten up on stuff.
Yeah, I mean, my gut is it's going to be kind of meh. Like, it's going to be, maybe it's down a little bit, maybe it's up a little bit. I don't see some really ugly open, and I don't see some kind of ripper either. So, I think that would be my baseline expectation. I don't see us like breaking through that 66 and change 6,600 level, which I think is kind of a important level. And again, with opex there, I do think that it'll be tried to be defended, and who knows? There's a lot of fuckery, to use the squirrel's word, on opex week. So be aware of that. Just as a general pro tip, I guess. But let's go back. All right. This is, everyone's seen this chart if you've watched this for a bit. The VIXN divided by the VIX, and then versus the NDX divided by SPX. When we were highlighting this in January, where the red circle, you always look for the red circles. My boy David Dredge taught me that. Red circles. You saw this red circle last year before the move into the August, July, spike in yen carry unwind. Saw the same thing, didn't get as low. And so I don't know. It doesn't seem like we're there. You've had a little bit of a NASDAQ rally versus, so we're kind of mid-game, which I think is corroborating with what we're saying, that it doesn't feel like we're at extremes, except for maybe some over-positioning right now, if that makes sense. This chart is just, the red line is the SPX divided by the 1 month vol, just to kind of vol normalize it. And that kind of says what I'm saying, right? Like, we've had a big move down in SPX divided by vol, not that big of a move down in SPX spot. And it's versus the 1 year forward, which have gotten a little bit of a move up, but nothing crazy.
Just go back to what you, before you go on to FX, just going back to what you said. Yeah, I agree with you. The market feels well hedged at the moment, but people are generally these days hedging in very short time frames, right? So they've all got to re-hedge, right?
That's a tough thing. I mean, I had a conversation with a buddy of mine who's like, yeah, I got a bunch of Russell hedges or puts, And he's like, yeah, I just wish they'd dump. I was like, and this was last Thursday. I think last Thursday we had a pretty big down move, right? Was it Wednesday or Thursday? Thursday. And I was like, I'd roll them right now. You know, it was an ugly day in the market. And he's like, well, I can't get as much coverage. It's like, well, that's kind of what rolling is, buddy. You know, I'm like, you know, I get it. But like, you know what, if they kind of keep it around or whatever, you know, you could end up with zero. And like, I'll give people an example of this. In maybe it's I don't know, sometime in January, February, I can't remember exactly when it was, maybe early February, I started buying KRE puts when KRE is at 73. And it's subsequently dropped 10 points from there.
Regional banks, just too much short. It's KRE, the regional banks ETF, right?
Yeah, exactly. And I got a really fast move. Then I sold this. So I bought the 70 puts. I sold the 67s to take out all the premium. And then we got a rally because that's what they do in OPEX week. And then on Thursday, I was like, what should I do with this? I let it roll, just whatever, and then dumped. You know, and so they do this sometimes where you don't get paid on until like after the OPEX, often after the VIX expiration and stuff. So just be aware of that. You know that.
And just be aware of that, and roll your shorter dated hedges sooner rather than later.
Yeah, it's just shorter dated hedges are just so tough. I can't tell guys how many times I've had the call right and dicked around with short-term hedges and didn't get paid for being right, you know, and, you know, you want to get as much leverage as you can for as little capital outlaid and then a defined risk basis. But you know what? Everybody in the world wants that. That's not like something that anyone doesn't want, right?
So true. So true. Okay, let's kick on to FX and then we'll go and talk about Farmer Squirrel.
Yeah, and this is actually interesting, right? Like this, and Rupert, we'll bring you in here because I know that this benefited you last week. This is, sorry, I should have made the legend bigger, guys. The black is the US dollar, yen, 3-month, 25 delta butterflies. The red is Euro USD, 25 delta butterflies. The blue is the Korean won. So, you know, Japan and Korea, big energy importers. Europe, pretty big energy importer. And then sterling, which is not as big, but, you know, one of the major currencies of the world just because they've been the financial leader for so long. And you've seen a really good move in FX fall, right? And so, again, a lot of these things are at levels where it's like, this is kind of the level, right? Credit spreads have gone up. We're now at the high since Liberation Day in credit spreads. We're we're at that level where the next level, we're getting to 22. I didn't go back to 21 because it screws up the scale. It's so high, you know, sorry about that. And, you know, but like, understand that in the next level is like a next level of this for credit spreads, for volatility across asset classes. And so, you know, the natural trader is starting to sell puts, like I told you that we did with their credit default swaps, you know, just for short term, because they're like, all right, if it goes there, fine. You know, if we get a rally back, at least we get some rebate on it. Some people are doing that just because, you know, these are mean reverting markets, and when you get the spike, it is always the trickiest game in the world to monetize.
Yeah, I mean,
Rupert, that helped you last week, right?
Well, no, I mean, so I mean, I had, you know, the hedge book had a great week, which meant other parts of the book weren't so good. But you know, the big performer in the hedge book was my 115 euro puts, right, which I'd already taken half off, right, on the early move, right, at the beginning of the month. The question for me now is, are we at enough of a spike now to, you know, take the rest of it off in anticipation of a reload? I mean, you know, I have to have dollar hedges on because, you know, the bias of my portfolio is for a longer term negative dollar. But so I can't be naked for too long. The question is whether this spike is enough for me to take the other half off.
And it's always a question, you know, if we revert from here, like look at the dollar, those dollar yen, like we're at the level we were at in 23, not quite there, kind of at, you know, is it the right spot? Well, you only know after the fact. So it's always easier to look back at a chart than it is in the moment.
Yeah, no. Listen, I'm looking at the red euro line, and I'm looking back at the sort of Liberation Day week, spike, right? And so we're still shy of that here, right? But, you know, it feels like I might be able to get back into this hedge at better levels soon.
Yeah. I mean, it's tough because look at 22, 21, you know, when it goes, it can really go. And because what that dynamic is, supply, people don't want to supply. So they start offering higher and higher. Demand goes through the roof. And you basically have a classic supply. I mean, look, what you see in silver in, you know, the end of the year up till mid-January, what you've seen in oil the last 2 weeks is just that's how markets work. You know, supply and demand in the short term and positioning is all that really matters.
Yeah. Listen, no decisions yet, but I'm watching it like a hawk, right?
Yeah, and you have to. That's
Any loss of momentum in this dollar move, and I'm out, I reckon. Okay.
Yeah, the DXY got above 100 actually last week.
Yeah.
This is the last thing. I thought I'd give a little touch to Rupert because I know he's a dollar yen bull and I am the opposite.
No, I'm a yen bull, not a dollar yen bull. I'm a long-term.
I'm sorry. You're a dollar yen bear and I'm a dollar yen bull. And I just wanted to show people, and we've shown this with the euro versus the dollar before, but you see how that skew lines up so well with spot. So sometimes you gotta look underneath the hood and see where's the hedging demand. When the hedging demand drives up, you know, that's often when spot. So we'll see. You know, Rupert has said many times, I think on the show, to me personally, that we're at that 160 level, and at the 160 level is where they've been, you know, prone to do interventions. My argument would be when you have an oil price spike, they might be a little bit more apprehensive to spend money on that versus, hey, we might need to spend that money on oil, you know, and LNG. So I don't know. But if it breaks 160, you could have a fast move to 175.
Well, you're positioned for it. I have to say, you know, I've been trimming Japanese equities aggressively over the last few weeks. The question is, you know, at some point I'm going to want to add them back, but you know, I might add them back hedged this time, and in terms of currency.
Well,
hedged.
And when I refer to the beach ball, it's just like how you put a beach ball underwater. You can keep it submerged for a little while, but eventually it comes back up. So that's my nickname for the dollar yen.
I can't talk to you about the yen while you've still got that digital on. It just sits there like a monkey on your shoulder. Okay, we're doing Ags Week.
Ags Week, let's go.
Let's go. Right, I've got to introduce you to a very evil character, which is Farmer Squirrel. I mean, firstly, you know, outline love 1970s analogies. Why not? Let's do one. But you know, it's a great point to note that food shocks were bigger than energy shocks back in the 70s. Right? Very different world, but worth bearing in mind. So here we are, Ags Week. I did a collab with our guest on Thursday, Nico Hoyt, who is a proper agricultural commodity expert. He worked at one of the ABCDs. He's setting up a sort of Bloomberg for ag markets right now. He's based down in Latin America. I mean, although he is an American, and I mean he co-authored my Revenge of the Malthusians note, which, by the way, if you're not a Squirrel subscriber, this one's a freebie. Blindsquirrelmacro.com. It's on the front page. You're welcome to read that and take a look. Essentially, I am long a basket of corn, wheat, and cotton. Actually, not that. I'm corn, cotton, and wheat in that order. And read the note, and it'll take you through the logic. But the reason why I engaged Nico's help this time is that until 2020, I'd never traded an agricultural commodity future in my life. I then caught the bull market in corn and soybeans in 2020 into 2021, and I became an overnight instant expert in ag. Farmer Squirrel was created. I then proceeded to give away pretty much all of those gains over the next 3 years, calling for grain bull markets. So this time I engaged some expertise. The squirrel is very much on team expertise, and my favorite expert here is Nico. Just some interesting chart, and all of these charts are in the note.
Wait, can I say something real quick? Can I interrupt you for a second? I just want to give the listeners like a little tidbit. I am not an eggs expert at all. This is one area of macro that I am going to be the junior guy on the call this week. And I did also have that experience Rupert did in 2008, I believe. And I caught corn futures going from like $5 to $7. And I was like, oh, this is great. I could just do this for a living. And then I promptly gave it all back in no time. And that was the end of my agricultural trading experience.
I'm still there.
That does happen to people.
Oh, listen, I have been reluctant to talk about grain prices for over 2 years now. But this is my first my first venture back into grains, well, since about 2023. So the cotton trade is interesting. You know, we've got a classic complacency set up in cotton. If you look at the market, you know, the trend guys have just been pounding it for the last 3-4 years. But the reality is that this energy shock has just made polyester an awful lot more expensive. I mean, this is the polyester cotton ratio on a weekly basis, and you know that is almost a 100% move off the lows in 23, right? And then finally, this is the weekly corn chart. You know, I'm not going to go into all of the details of behind the bullish setup, but the basic premise is that we have a fertilizer shortage just at the key time for Northern Hemisphere planting. We have the USDA being way too relaxed about balances in the corn markets, and we have you know, possibly a major overestimation of corn acreage in the Northern Hemisphere. So this all sort of contributes to a really asymmetric setup. I think that the charts in all three, I didn't talk about wheat, but that's a much smaller position. Wheat is an absolute killer to trade. It's the widow maker of the ag complex. But the charts on all three allow you to risk manage in a really intelligent way. And I'm talking about you could take 50 basis points of risk for a potential 5-point move across the basket. Anyway, take a look at the note. It's there. It's free. And my co-author Nico will be joining us on Thursday. And I mean, he's just written a great paper on thinking through the difference between paper and physical markets in agricultural commodities, and I think we're going to use that as the framework for Thursday's discussion.
I also think you got to remember that's across commodities. I remember at the beginning of the gold bull market, I caught wind that Ghana had bought gold was about $2,200 at the time, and Ghana had bought huge supply in a private market at $3,000, and I was like, oh, that's interesting. And you know, you hear these stories about physical barrels of oil trading at 30-40% premium right now. Now you never know what the amount of supply is, but that is something to be aware of, and that is also a sign of extremely tight markets when you get the massive backwardation where spot is at a huge premium to paper, basically.
Yeah, I mean, listen, I mean, we're all fixated on Brent and WTI prices, but there are 30 different prices, or 30 plus different prices for crude around the world, and you never know which one's in truly in short supply. I mean, you know, down here in Australia, we only refine 20% of our product consumption here. You know, I mean, ultimately, we're not going to run out of gasoline in Australia, but what we're going to end up doing is overpaying for someone else's cargo, and it kind of won't go to Thailand, or it won't go to some other place in Southeast Asia. You know, wealth always prevails, but the price at the pump's going to go up.
Yeah, it should be an interesting week. You know, the state of play in this war has definitely surprised to Iran being more able to retaliate than people thought. The political will, the people starting to feel the strain, and I sent Rupert a thing about how tight the inventories are becoming in Australia. Told him to go fill up his gas tank this weekend. Maybe bring a couple gas canisters with him.
That's right. I mean, I barely drive my car these days. I'm not too fast. Now, if they start
that's a good way to be.
If they start cutting subsea cables and I'm cut off the internet, that's a different problem. Anyway, we'll focus on that another time.
Let's worry about that when that bridge is crossed.
Let's chat again on Thursday. Benny and the Squirrel out.
Yeah, we'll see you guys Thursday. We're out.